Hello and how are you doing? This is Accounting Room channel, the place of learning accounting and finance concepts using simple English, as you know. So, in our previous video, we have discussed on the accounting equation, and we also have explained the accounting elements one by one in detail. So, in our today's lesson, we are going to discuss on the basic accounting concepts and principles. So till to the end of this video, keep learning and keep watching. So now let's get started. So accounting concepts and principles, when we say they are the guidelines and the procedures which guide and shape the activities of accountants. So as an accountant, a given accountant may deal with issues like business transactions and financial events. So whenever an accountant deals with such issues, and whenever he prepares any financial statements and reports, he should follow such rules and regulations, guidelines and procedures called accounting concepts and principles. So these accounting concepts and principles are not natural laws like the law of gravity, for example. In physics, there is the law of gravity. This law is a constant law which is not changing from time to time. But when we come to accounting concepts and principles, these rules and regulations, they are changeable over time depending upon the global issues and some other reasons. So what are accounting concepts and principles? Let's proceed to it. So accounting principles, sometimes referred as accounting concepts or accounting assumptions. Of course, these three terminologies have their own differences. So the first accounting concept is the business entity concept. So the business entity concept assumes as a business and the owner of that business are two different bodies, which means when you prepare any financial statements for your company, you should only use data and information related with that business, which means you don't have to expect to use personal issues. As a owner, the owner may have different kinds of personal transactions, like he may purchase some utensils for the family, setting a budget for his children's. Maybe the owner may buy some personal assets like clothes, shoe, and some other personal issues are there. So those personal transactions should be recorded separately from the business's asset, which means they should be kept separately from the assets of the company. So the business entity concept sees such two different things differently. When we come to the second concept, it is the going concern concept. So the going concern concept says a business should be assumed to have a continuing or indefinite life, which means whenever you start any business, you expect your business to be operate or to be survive over a long period of time, which means for unlimited period of time. This is the going concern concept. So when you apply this going concern concept, you differentiate, or you report assets and liabilities as current or long-term assets or liabilities. So the going concern concept is the most important concept in accounting principle, since any business organizations at the beginning assumed to be survive over a long period of time. When we come to the third concept, it says the monetary unit concept. This is sometimes said to be the unit of measurement. So this unit of measurement or the monetary unit concept says any accounting transactions and the results showing in the financial statements are expressed in terms of their money values, which means, for example, if you purchase 10 computers for your company, you don't expect to write such quantity of computers on the financial statements. Rather, you need to record their amounts or their total costs in terms of money value on the financial statements. This is money unit concept. There is a drawback concerning with the monetary unit concept. For example, if you assume the knowledge of employees, the experiences, their talents and some other issues are not measured in terms of money. I think this is the drawback of the monetary unit concept. When we come to the fourth basic accounting concept, it says the time period concept. This time period concept sometimes referred as the periodicity concept. So the time period concept assumes that an entity's life can be subdivided into equal time periods, for example, months, semi-annuals, or years, to prepare a useful and timely report. So most often, most companies use the specified period of time for reporting or preparing financial statement, 1 year or one accounting period. But at the middle of each accounting period, some sort of reports like interim report can be prepared and provide to the information users or the accounting information users. Proceeding to the next slide, the fifth basic accounting principle is the objectivity principle, which means data that are entered in the accounting records later reported in the financial statements of a business generally should be supported by source documents or some other records that are both objective and a verifiable form of evidence. Whenever you purchase any assets in the market, such purchased assets should be supported by source document like the receipts and some other invoices will be there. So such invoices and bills and some other receipts should be supported by such transactions. So this is what we call the objectivity principle. The other basic accounting principle is the consistency principle. So this principle assumes or requires that a particular accounting procedures or methods and reporting practice, once adopted, should not be changed from one period to another. So when you apply a FIFO or first in first out evaluation, inventory evaluation method for your evaluation purpose, so you should use such FIFO method for a certain period of time without changing into LIFO or other average method evaluation method, which means if you apply once a given accounting practice, such accounting practice should be continually used by the company over a given specified period of time, unless otherwise if you change one accounting practice into other within a short period of time, it is impossible to even evaluate the performance of that company, whether the change, for example, if there is net income which is changed for this period of time, whether that net income is arised from the normal operational activities of the business or from the change, the amendment of the accounting practice, we do not know. So in order to certainly now the changes coming into the company in the net income and loss. So in order to differentiate such activities, we need to apply the same accounting practices over a given specified period of time. This is the consistency principle. The other one is the cost principle. So this cost principle states that assets are recorded and subsequently reported at their purchase cost, and that the accounting records of the assets continue to be based on cost rather than current market value. So if you purchased a given machine for $1,000 in the past year, let's say 2021, you purchased a given machine for $1,000. If the current market value of that machine in the market is $2,000, in spite of the change of the cost of that machine, you need to record or you need to report any financial statements of that machine by recording the original cost or the recorded amount of cost for a long period of time, even for indefinite period of time. This is the cost principle. So sometimes some changes of the cost can be arrived, so we do not assume such changes. We need to report at their original cost. The other basic accounting principle is the revenue recognition principle or the revenue recognition concept. So this concept is that revenue should be recorded when it is realized and when it is earned. So there is cash basis accounting and accrual concept or accrual basis accounting. So we will differentiate such two issues in the future, but for now any revenue should be recognized based on revenue recognition principle when we earn and realize that revenue. So revenue is recognized whenever we sell out some items or assets, and even though we do not receive any payment or any income when we sell out some assets, so we need to recognize revenue at that time. This is the revenue recognition principle. So dear followers of Accounting Room channel, we will elaborate and we will discuss on the remaining accounting principle in the coming video. So till to then or until then, have a good and wonderful time.